My favorite strategies are buying an asset using debt that pays you to hold it.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It Passive Investing Podcast Edition. My name's Randy Smith, and I'll be your host today. And I am really excited to have Bronson Hill with us today. Bronson is the managing partner of Bronson Equity, and he has just become an expert in this space. I think you've been investing since 2006 in the real estate space. So, Bronson, welcome to the show.
Hey, Randy, excited to be here. I love the gentle art of crushing it. So it's so like a violent term with like a gentle, like with finesse. So I love it. So it shows that you have class and strength.
Very good. And I guess that is how we do it here, right? A little bit of class, a little bit of strength. So, well, why don't we go ahead and jump in? Can you kind of tell the audience a little bit about yourself and how you found your way to the passive investing space?
Sure. Yeah. So I was a well-paid medical sales professional. I worked in medical device sales. It means that I would go into surgery and I would wear scrubs and I would consult cardiologists on how to, work with their surgeries. We had some specialized equipments for heart surgery. So I did that for about 10 years in different areas. I was making over $200,000 per year. I just really wanted more control over my time. And I realized that by me working a job, it would not give me that amount of freedom. I even had two physicians that I worked with that they worked 60 to 80 hours a week every week, and they were making $2 to $3 million a year. So they're making a lot of money, but I didn't envy them because I wanted to have the freedom to be able to travel. I wanted to have the freedom to be able to create. And so I, learned about multifamily. My plan initially was to get a bunch of single families. And then I had a cousin I hadn't seen in years who was a multifamily guy. Said, "Hey, why don't you do multifamily?" And I said, "Well, I'd love to, but I don't have the money." And he taught me about syndication, raising the money. And basically, I've gone on a journey the last 4 years where I raised about 30 million, was able to leave my great corporate job, replace my living expenses. And now I help other people to replace their income with passive investing and also try to get to a place of reducing taxes or even paying zero tax potentially.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Love it. So this is the ideal avatar for our audience, the folks that have done very well financially, have high W-2 income, and have this desire to buy back their time, buy back their freedom so they're not having to work 60, 70, 80 hours a week to make that type of income. So very interesting. Now, you skimmed over a lot of information in a short amount of time there. You said you started in single family, very quickly moved over to multifamily. But for some of the folks that might be on a similar path, can you talk about some of the nuances in that transition, or why did you choose single family first, and what kind of drove you or what piqued your interest from that conversation with your relative about multifamily?
Yeah, so I think in general, I always knew I wanted to be a real estate investor, and I think that a lot of us we are drawn to single family because that's what we know, right? Most of us have lived in a house at some point, especially people that are high net worth or make a good salary. Usually, people live in houses. So if it's like, hey, I want to do real estate, well, I know houses. We don't even think about. We don't consciously think this, but it's kind of how it works. Or we think that those apartments, they just feel too big, and like, how does that even work? So my goal was to get 30 houses in the Cleveland area. I had 4 or 5. And so I was trying to get this portfolio together, and it looked great on paper. But yet when I was actually, even though I had a property manager, it took up way more of my time than I wanted, even though they're like saying, hey, the tenant's not paying again. What should we do? Should we evict them? This issue's going on with the house. How do you want to repair this? Or you need to send some cash over. And I was like, I thought it was supposed to cash flow, not me just keep putting money out there. So on paper, the numbers looked great, but it didn't always work out the way it penciled on the back of a napkin. And so, and then I realized just with the amount of cash flow I was actually getting from these 4 or 5 houses, it was very difficult. I mean, if you get 100 to a few $100 a month, maybe per house, like that was really good. I think these days it's hard to find anything that really even has positive cash flow when you actually take into account your mortgage payment, if you have a property manager, any sort of repairs. And so it's a very, very long-term way of trying to become wealthy. And it works out for people, but it works out a lot of times over a 10 to 20 year period. And I thought, I just don't want to wait that long. And so when I learned about multifamily, what was really appealing was that I didn't have to do the work myself. I could basically be a part of investing my own money. I could invite other investors to be a part of that. And then I have partners that basically I'm a part of the asset management, but I'm not the one that finds the deal. I'm not the one who's doing the day-to-day operations. And it becomes much, much more efficient. I mean, a 100-unit apartment complex is way more efficient than 100 single family houses. You just think about the mechanics, right? If you have an issue at one house, you've got to pay a repair guy at $50 an hour, whatever, go to that house, find the part, figure out what's going on, go to Home Depot, then come back, whatever. It's a half to full day project just to do one house versus if you have 100 units in one place, you have basically a lot of synergies. You have a lot of same paint colors, same appliances. You typically get a discount on the labor because they're full time with you. So instead of paying $50 an hour, maybe you're paying $20 or $25 an hour, and you've got stuff for them to do all the time. You've got a full-time property manager dedicated. And then it allows me, even though I'm an operator, it allows me to become more passive. So I don't actually have to be the one who's managing all of that. So many advantages. I just tell everybody, everybody I talk to is say, what advice do you have? I say, go as big as you can, as soon as you can, or be as passive as you can. Don't try to do it yourself. Anybody who owns rental property knows that the promise is it's going to be passive, but even if you have a property manager, it's not always very passive.
Yeah, no, I love it. So yeah, I had a similar path myself in that I started with single family and then wanted to move over to multifamily as well. But I thought that I would go the active route in multifamily to start and found very, very quickly that I was not equipped and did not have the expertise or the skills or the network or the knowledge to jump in and start buying those, 100 unit, 50 unit, 80 unit, whatever that was, even quite frankly, 10 or 12 unit at the time. So did you start first by passive investing or did you jump right into active in the multifamily space?
Yeah. So how I got my start, I had learned, from this cousin of, to do multifamily, I could raise money. I went to an event on basically how syndication works, which was a great event. And I continue to go back to this event. And then a lot of the books I was reading about multifamily was saying you should start a meetup. So I decided to start a local meetup in the Los Angeles area in Pasadena, where I live. And at that first meetup, I basically had partnered with somebody who ran a meetup. And I said, hey, let's do another meetup and only focus on multifamily. I said, I'll do all the work and you just show up. And she's like, well, that sounds like a great idea. So I did a lot of the work. We helped promote it. We had 60 people at the first meeting. This was 2018. I think it was September of 2018. And so we had 60 people there. And out of that, some guy just comes up to me out of the blue and is like, hey, I'd invest in one of your deals. And I was thinking like, well, wow, that's really amazing. I'm not even in the industry yet. I'm just like a leader in the front of the room leading this. So I got coffee with him. And I basically, showed him a sample deal, what it looked like. And he said, yeah, I'd invest like 100K and something like that. So he basically was interested, and I introduced him to another guy at that meetup who had a deal, was looking for money, and it had similar parameters. And so that became my first investor. So that's really how I got started. And a lot of people wonder, like, do you have to do everything, right? And I kind of felt like initially, I've got to do everything, but it's really a team sport. If you've ever done single family, it might be you and a property manager or you and an agent or something like that. But with multifamily, one person can't do it all. Not one person typically never raises all the money, doesn't do all the asset management, doesn't find the deal, doesn't do all those pieces. It's usually at least a few people that are involved in that. And so it's been great just to realize, okay, I'm really good at educating people and being a part of a team and helping find the right people to help as team members to be a part. And then I also passively invest as well.
Okay. Yeah, very good. I love that you talked about the fact that this kind of just organically fell in your lap. It sounds like a connector. You do very well talking with folks up in front of a crowd, probably from years spent in the sales environment, getting very comfortable talking with high W-2 income folks. So I'm curious now that you're in the space, you've been investing in the space for a number of years. Does multifamily still check all the boxes? Do you feel it's still a great place for investors to be putting their dollars, especially with everything that's going on with the market right now?
Yeah, so it's a very interesting conversation because multifamily has changed. There's no doubt multifamily's changed the last 6 or 8 months. The lending has changed. We've gone from a year ago a 3% interest rate to a 7%. And valuations, they've kind of stabilized. They've started maybe stay there, maybe come down. Rents have kind of stabilized. Certain markets they're still growing, and in the markets we're buying in Jacksonville, Florida, they're still growing a little bit or kind of stabilized. But I think it's a really special time in multifamily, and I'm going to explain why here in a second. But multifamily is such a great asset because it hedges against inflation. Right now, inflation is a huge risk. The confused mind will just say, I'm just going to wait. I don't know what to do, so I'm going to wait. And if you have money just sitting in the bank right now as a passive investor, you're losing, the official rate is 7.1%. If you look at a site like shadowstats.com, they look at actual inflation, is actually north of 15%. So if you believe that it's actually of actual costs, which I do, I think it's actually north of 15%, then you're losing 15K off of 100K invested per year. And if you wait 2 years, that's between 30 and 40% of your wealth just sitting in a bank.
So, Bronson, can you dig into that a little bit where you say, because the published number is around that 7% that you hear, and then you reference like the real inflation. Can you walk the listeners through that variance and why we're hearing such a discrepancy in those numbers?
Yeah. So the CPI, which is known as the Consumer Price Index, is how they determine how inflation is actually working. But the problem is it's a manipulated number. A lot of government data is manipulated, and it's unfortunate that's the case. But there's several ways that they do it. One way is that they count a lot of things as being temporary. So they say that okay, if it's not over a 12-month period, it's just a temporary increase of price. So for a while, the Fed was saying, oh, this is transitory inflation. This is transitory. It's gonna, and of course, it didn't go away. It got worse. So they're saying that it's transitory. Another way is they'll do substitution. So they'll say if you love apples and the price of apples doubles, they say, well, you love apples, but you would switch to oranges because oranges are the price of what apples used to be, and so you'd switch. Or if you have a 2-bedroom apartment that's $1,000 a month and it goes up to $1,200, they say, well, you would make the decision to move down to a 1-bedroom that's $1,000. So that doesn't change the inflation numbers at all, the apples to oranges comparison, or that, which is just not true. And then the other thing they do is they just keep substituting those things in. And so that's why at 7.1%, that's the lowest they can possibly get it. They're not very transparent about how they do it. They publish usually a 50 to 100-page document of how they did it. And I just can't understand it. I mean, they go from this number to here. And even if you're a mathematician, how do you understand this? So it is a very manipulated number. Some people call it the CPI lie or the CP lie. But yeah, it's unfortunate that that's really how they do it. But I think everybody needs a plan when it comes to inflation, because otherwise, if you're not on the side that you own assets, then you're always going to be hurt by inflation. You're going to be the one that goes to the store. Everything costs more. The food costs more. The gasoline costs more. Everything costs more. So the only way to take advantage of it is you actually have to be on the side where you own assets that hedge against inflation. And the advantage is if you can have debt that you're buying, you're usually buying an asset with debt, which multifamily allows for. You put a certain percent down, you're hedging inflation, you get the tax advantages, you get all of these, depreciation, all these other things as far as taxes. And then it's a much less volatile investment than more traditional investments such as stocks and bonds, which I was an investment advisor for a number of years. And I would just watch how, we're taught that these are very traditional investments. But anyway, very long-winded story. I
appreciate that. And I think the simple stat that you used, if you have $100,000 sitting in the bank, 3 years later at 15% per year, you've essentially cut the purchasing power of that 100,000 in half. So the new passive investor that is saying, the stock market's going down. I'm afraid to pull my money out of the stock market today because I want to be in there for when it goes rocketing back up again. How do you answer that question with investors? Because it's something that I hear quite often.
Yeah, and it's really this is just so fascinating to me because I feel like it's like we've been gaslit as a group to believe that stocks and bonds are traditional investments. There was a time in 1929 where price earnings ratios were very similar to where they were in 2022. I think it was about a 32, and stocks crashed. Everybody knows about the great crash of 29. Well, people don't realize that it didn't get back to 1929 numbers for 25 years, which was 1954. And that was in nominal terms, meaning that doesn't even take into account inflation. So it could have been 35 years by the time you even get back to break even. So there was a time in there where people would say, why in the world would you ever invest in stocks? But what's happened in the last 30, 40 years is ERISA, which is a law that went into place about retirement accounts. There's trillions of dollars that are in there. And basically Wall Street spends billions of dollars convincing us that these are safe traditional investments when stocks have crashed multiple, 30 to 50% multiple times in a 12-month period over the last number of years. And I just think if you were to just pitch a stock or even a mutual fund or some sort of index fund and not give what the asset is and say, hey, I've got an investment for you. Over the last 100 years, we've had, probably 10 times it's lost, 30 to 50% of its value in a 12-month period. Do you want to invest? And some of the things I was like, well, why would you ever do that? But it's because we're conditioned that these are safe traditional investments versus real estate or other real physical tangible assets. These really are actual assets.
Yeah, absolutely. So not the time to have money in the market, not the time to have money sitting in the bank, introducing multifamily and some other alternative assets as well. So talk about, if you can, some of the benefits of some of these other alternative investments.
Yeah, let's come back to multifamily for a second, because a lot of people are saying, well, I should wait. And, again, I should not invest now. Americans currently have $5 trillion in savings and checking accounts. And it's the most we've ever had. The most prior was just over $1 trillion back in 2020. So in the last 2.5 years, we've gone up 5x, and it's the most we've ever had. So there's all this money on the sidelines in people's bank accounts, whatever. So what's happening right now is because interest rates are rising, valuations of multifamily apartments are stable. I wouldn't say they're declining, but they're stable, maybe slight declines, but they're stable. But what's going to happen is when interest rates change. Now, interest rates, when you buy a property, let's say we buy a $10 million property, the buying price is fixed, but the interest rate can be adjusted later. I'm going to say that again, right? If you buy a property, even if it's a house, $100,000, you buy it, the buying price is fixed, the interest rate can be adjusted later. So what's going to happen is when the Fed says, hey, we're not going to raise rates anymore. Hey, we're actually going to start cutting rates. It's on average, it's been 5 months from the date of the first rise to the date of the first cut. Since they've been measuring this since around the 50s, I think it was 1952, every single time it's been between 1 month and 13 months. 13 months is the longest they've ever gone when they've actually raised rates before they've announced a cut. So that means that if it goes 13 months, it's going to be April of this year. It could be a little bit longer, a little less, but I think in the next 3 to 6 months, due to recession, due to some other crisis, something else, they're going to start lowering rates. And what's going to happen is now rates are coming down. Lenders are going to want to lend. People are going to want to invest, and all this money is going to flood in. And we're going to look back on this time right now and say, man, I wish I had invested a lot more in multifamily.
Yep, absolutely. And the price of these assets will go, again, not through the roof, but certainly increase at that point. So interesting. Yeah, I appreciate your expertise in this space and your details about some of the historical perspectives as well. I had no idea that the number was 5 trillion. That's amazing to think that there are all those dollars. And if you tie that back to what you said earlier, $5 trillion sitting in the bank, essentially decreasing by 50% of purchasing power over a 3-year period, that makes for a pretty scary environment for the population fast forward a few years if they don't make the right decisions with their dollars today. So very good. Yeah, so it's a great time for multifamily. Inflation is definitely struggling. Do you like other asset classes as well, or how else do you manage and arrange and curate your portfolio to make sure that you're hedging some of the other concerns that might be out there?
Yeah, that's a great question. So yeah, we do a lot of alternative assets. And I'm not totally anti-stocks. I mean, there's certain things I do invest in. I just think as an investment strategy, the 60-40, 60% in stocks and 40% in bonds, I think it should really be rethought, because that portfolio has done terrible. I think it lost 20% in 2022, right? So finding other things that have done well, that cash flow. My favorite strategies are buying an asset using debt that pays you to hold it. Right. So that could be multifamily. If you can be passive, that's awesome, because you don't have to do the work. I invest passively in other multifamily deals. I do it in self-storage, mobile home parks, done different types of deals. We personally, or at our company, we're doing stuff in the ATM machine space, which is probably the most predictable monthly cash flow investment I've ever seen. We have actually a deal we're working on that will probably be available by the time this is out, or it might be closed, but we'll reopen it. It has to do with car washes, where it's a large car wash franchise that we're going to be offering that has a great IRR. I also love, I I think there's a case for precious metals, not for a sense of as an investment, meaning like I'm trying to get a cash return on it, because it doesn't return. You know, if you buy an ounce of gold, it's worth an ounce of gold. It doesn't return anything, but as an alternative to cash. And one reason is because you can't print more metals. There's a great video. There's a great video series on YouTube called "The Hidden Secrets of Money." And it's a 10-part series. The first one's about 17 or 20 minutes. And it just gets into this 5,000 year history of precious metals being money. Not that it's like, because there's a difference between currency, which is a $20 bill, which they can create more of, versus money, which actually stores value. And right now, central banks and governments are just stockpiling as much, not in the US, but other countries, as much gold and silver as they can. So I think there's a case for that. And there's actually a play. If you have cash, you can put money into metals and it can become liquidity for you. So there's a third-party vault that I use where I store physical metals there. They charge 0.5% of the current value per year, and then I can borrow against the current value of it at 75% loan to value at maybe 6.5%, 7.5% interest, and it's like a HELOC, right? So it's a way that I can have I don't have to have money in cash, in currency. I can have it in something like metals. And, if I have a short-term need for liquidity, I can use it. So that's another strategy some investors are utilizing.
Okay. Yeah, that's interesting. I've not heard of that one. I am very interested in the ATM space. I've put a few dollars there myself and I really like the cash flow that I'm getting from that, quite frankly. Can you talk a little bit, though, about this concern or fears that ATMs and cash might not be used in the future, which would decrease our dependence on those machines?
Yeah, it's a great question. I think it is. Every investment has risks involved, and I think the principal risk of the ATM machine investment is basically, will people stop using cash? Now, this conversation has really been there since the 90s, that everything's going digital, people won't use cash. And it's amazing to me, Randy, how, and you're invested, so you understand some of this as well, but the more digital we go, the more paper and the more cash is actually used. So the cash usage is actually going up, the number of transactions going up. And the question is like, well, who is actually doing this, right? Because most of my, 50 or 60 or more ATM investors, I haven't paid for an ATM fee in years. Even if I travel internationally, I usually don't pay for a fee. It's very rare, but there's 5 to 10% of the population in the US, which is considered, the unbanked, the underbanked. It's typically immigrants, people that work with cash businesses or get paid under the table. But even now, government benefits, they come on a debit card. So people go in and it's just the habits of some people. It's a little curious, but they'll go out and take $40 and pay the $2 fee every week or every other week, and it's no big deal. So there are people that are using it a lot, and there are certain businesses that are utilizing it. I don't think cash will go away in the US ever. That's my opinion. And the reasons for that is there's issues politically right and left. On the right, they would say, well, the government shouldn't immediately know all your business, because if cash goes away, that means the government is in every single transaction and they know all the business of everything, right? So there's some privacy issues there. The second side of that is on the left. Who would this hurt if we do away with cash? Well, it would primarily hurt these immigrants, these unbanked. So I don't think there's a political will to do it. And I think the other thing is not to look at, will it ever happen? It's just that typically, like the investment we do, this isn't a pitch, but just explaining, it's a 7-year hold or 7-year investment. And it's really to say the payback period is just over 4 years. And if you count the tax benefits, it's more like 3 years. You say, well, in the next 3 to 4 years, do you expect this to happen? I don't think it's going to happen. Of course, my opinion, I don't think it's ever going to happen, but I also think in the next 3 or 4 years, I don't think it's likely. So that's what I would say, kind of looking at that.
Yeah, in worst case scenario, I think even for the 7-year time horizon, I think we're very safe with 7 years. And it would be a very long transition away from cash. And as you mentioned, it's actually increasing in usage over the last handful of years. So very good stuff. So talking specifically to the newer passive investor, you and I have experience with a number of different asset classes, a number of different deals, operators, markets, all those types of things. But for the new passive investor, this can be, I always think back to that first wire when you walk to the bank and you say, I want to wire my $25,000, $50,000, $100,000. That's a scary time. Can you, or what type of information do you share with passive investors when they're doing that first investment to make them more comfortable with that transaction? on the front
Yeah,
end.
no, I think, yeah, it is something that, there's all kinds of crazy fraud things out there, both from wire fraud. I sent a wire over for an investment today in the energy space, and my bank, Chase Bank, oh, was this really you? Do you understand that, we can't get your money back if you send, there's a lot of stuff out there, and it's good. It's good there are those protections there. But I think in general, there's a lot of ways, because really your question is, how do you vet an operator? Right? How do you know if somebody's like legit? How do you, first of all, that it's not a scam? And then secondly, is that they're actually good operators. So there's a couple of things I look at. And it comes down to credibility. If people that have, podcasts like you do, that are going to conferences, that people say good things about them, they're doing deals with reputable people, they have some sort of track record they can show. I think all of that is, and actually it's really interesting. There was a guy in the triple net space just recently who got indicted for some federal thing. And he claimed to have a net worth of 150 million in only 3 or 4 years of doing it. Was just, the numbers just didn't make sense. So there's something you have to use the common sense stuff too. And so, and I don't know that investors lost any money. I just think he misrepresented some things. I don't know all the picture of it, but anyway, when it comes to vetting deals, its reputation is huge. That's why I think any passive investors should go to meetups. They should go to conferences, at least one or two a year, because you get to meet people and you get to know, and it's a very small industry. And so sometimes I'll have investors ask me like, "Hey, do you know who this person is?" I remember one time getting something from an investor, and it looked like it was like a click funnel kind of thing where you get on, and it's like, I was thinking, man, I know a lot of people, and I don't know, I've never heard of this guy, so I said, I don't know. So I told her, I said, I'd be really cautious. I don't know who this person is, because, that's the person you want to watch out for. It's something who's just kind of created, and you're like, I don't know, is this person even real? But, you can request a background check on somebody. You can ask to talk to other investors. You can do track record. I also look for someone on the team that's actually been doing, multifamily or whatever the asset is for over 10 years, if possible, because it builds credibility. And that's something for somebody who's not passive, or maybe is passive, but wanting to become active. It's just, credibility is huge, right? So having someone who has a lot of experience is really valuable.
Awesome. Well, very, very good information. I appreciate it. I feel like we could, personally, I'd like to dig in and ask personal questions about strategies and things like that. But this is really geared towards the newer passive investor, so we won't get into those weeds right now. But anything else you would care to share with the audience, the first-time passive investor, that could be beneficial to them?
Yeah, I mean, I would say, I've spoken with over 1,300 passive investors, net worth 2 million or more. And I think the biggest thing I see is just a lot of people, they get stuck in analysis paralysis. And I would say, look at 5 to 10 deals, and then invest in one. And it will probably go just fine. Maybe look and make sure the deal makes sense to you. It also really helps if you can find other passive investors that have some experience. So that's a great person for you to meet as a passive investor, is another passive investor, because they're not trying to sell you anything, right? If you're an operator like we are, you are like, we have a deal. We have something we kind of steer people toward, and there's nothing wrong with it. That's what we're doing. Somebody's a passive investor. They're not selling anything. They want to help other people. So if you can find those relationships at a conference, at a local meetup, that could be a really transformative thing for you as an investor and help make you feel much more comfortable.
I love it. Absolutely. So resources for our newer passive investors. Do you have any book suggestion, podcast, anything that you would like to share with the audience to help them along their way?
Yeah, I'm actually writing a book right now about passive investing. So it's not out yet. I'm hoping in the next 6 months, it will be out probably late first half of 2023, or maybe second half, but
Awesome.
soon. And I do have a couple ebooks. One is called How to Use Inflation to Your Advantage. And it's 50 color pages on just some of the strategies I mentioned, getting started in multifamily, some of the other things on even precious metals and looking at other different alternative assets. That's at bronsonEquity.com. You can download that. We also have a YouTube channel, have a podcast called The Mailbox Money Show. And I'd love to connect with individuals, or if people want to reach out and hear about our deals, you can do that on our website as well.
Fantastic. And any good books or podcasts that you would suggest to the newer investor?
Well, The Gentle Art of Crushing It is a pretty good show. You ask good questions.
There you
You're
go.
just getting going. So I'm excited about this show. Yeah, I mean, there's so many good podcasts. I don't even know where to start on that. There's so many. I do a lot of audiobooks, but I think for investing, there's a really good book by my friend Justin Donald called The Lifestyle Investor. That's a very good book. Just talks, kind of how do you create passive income in your life. And that's one I've enjoyed over the years. If people have not read Rich Dad, Poor Dad, that's number one. And the second one is Cash Flow Quadrant. I actually liked Cash Flow Quadrant, the second book in that series, even more than the first. So that's something, if somebody has not read that, I would look at that.
Very good. Very good. Well, you've been amazingly entertaining and brought a ton of value to the audience. I really, really respect what you're doing out there and have been following you and enjoying what I'm seeing there. So thank you so much for coming on our show today. I appreciate your time.
Thanks so much. Appreciate it, Randy.
All right. And to the audience, as always, continue to get educated, get inspired, meet other passive investors, and continue to do so until you have all of the information you need to make that first passive investment. Once you do make that first passive investment, we're confident that you will find a path to decreasing your dependence on your W-2. So thanks so much for joining us today, and we'll look forward to having you on another show. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.